The inverse Head and Shoulders is the bullish counterpart to the classic Head and Shoulders, and it's studied as a potential bottoming pattern after a sustained downtrend. It forms in 3 stages. Price falls to a low, the left shoulder, then bounces. It falls again to a deeper low, the head, then bounces a second time. Finally, it falls a third time, but only reaches a low near the depth of the left shoulder, the right shoulder, before turning back up. Connecting the 2 bounce highs in between creates the neckline, which, like its bearish counterpart, can be flat, rising, or falling. Volume plays a key role in how this pattern is evaluated. Ideally, volume contracts through the left shoulder and head, reflecting fading selling pressure, then expands noticeably as price breaks above the neckline. A breakout on weak volume is treated with more skepticism, since it increases the odds the move fails. As with the standard Head and Shoulders, formation alone doesn't confirm anything. Traders studying this pattern typically wait for a decisive close above the neckline, and often for a retest of that neckline as new support, before treating the reversal as valid. Jumping in on the first touch of the neckline, before any close above it, is one of the most common ways this pattern gets misread. Risk management follows a mirrored logic to the bearish version. A stop loss is typically placed below the right shoulder, since a move back under that level would undercut the bullish reversal thesis. A measured move target is often estimated by taking the distance from the head to the neckline and projecting it upward from the breakout point. Though, again, this is a rough planning tool, not a promise of where price will go. It's important to understand where this pattern tends to fail. In strong, persistent downtrends, apparent inverse Head and Shoulders formations often just get overrun as selling resumes, especially on lower volume or thinly traded instruments where the pattern can appear without a genuine shift in supply and demand. Context matters. The broader trend, volume behavior, and price action around the neckline all factor into how reliable the signal actually is. This pattern is best studied alongside its counterpart, the standard Head and Shoulders, since the confirmation logic, volume behavior, and risk framework mirror each other closely, just applied to opposite trend conditions. This video is for educational purposes only. It does not constitute financial advice, and trading involves substantial risk of loss. Always do your own research, and consider your own risk tolerance before making any trading decisions.